So, if you're in a business partnership in Malaysia, you've probably heard this term thrown around: provisional adjusted income. Now, I know it sounds a little intimidating, but trust me, it's the absolute starting point for figuring out your taxes. Let's break down what it is, why it's so important, and how it all works. You ever just stop and think about it? Your partnership makes a profit, which is awesome, by the way, but then what happens? How does that money actually get taxed? It's not as simple as just splitting the cash. There's a formal process, and that's the puzzle we're going to solve right now. Right. Here's the number one thing you got to get straight about partnership taxes in Malaysia. The partnership itself, it doesn't pay a single ringgit of income tax. The tax authorities kind of look right through the business and focus on the individual partners. But before they can do that, everyone needs to agree on one number: the total profit of the business as a single entity. And that brings us right to our first stop. We've got to define this key term, the one at the very heart of this whole calculation: provisional adjusted income. Okay, so what is it? Provisional adjusted income, or PAI for short, is the net profit of the business after you've made a bunch of tax adjustments. But, and listen up because this is the most important part, it's calculated before you factor in things like partner salaries or any interest you paid them. It's the raw, uncarved profit. Let's make this easier. Imagine you just baked a cake. The provisional adjusted income is the entire cake, fresh out of the oven. It represents all the profit the business made. We haven't sliced it up yet. We haven't decided who gets a corner piece. It's just the whole complete cake. And that's exactly why they use the word provisional. It's a temporary number. It's the income of the partnership as a whole, just for a moment, before it gets officially divided up and handed out to each partner. It's the starting line for everything else. So how do we actually get to this PAI number? Well, it's not as scary as it sounds. It's a pretty clear step-by-step process. Let's walk through it. It's really just 5 simple steps. You start with your normal net profit, right from your books. Then you do the tax magic. You add back any expenses that the tax office doesn't allow, you might deduct a few things you missed, and then you adjust for capital items. That usually just means swapping your accounting depreciation for something called capital allowance. And boom, you get your PAI. So what are these non-allowable expenses we have to add back? Well, the big ones are any payments to the partners themselves, things like salaries, bonuses, or interest on their capital. See, from a tax point of view, that's just partners paying themselves. It's seen as a distribution of profit, not a business expense. You also have to add back accounting depreciation and, of course, any personal expenses that snuck in there. Now, let's just pause on depreciation for a second because this one trips a lot of people up. You add back the depreciation from your accounts because the tax rolls have their own system for this. It's called capital allowance. So you take out the accounting version, and in a bit, you'll put in the tax version. Simple as that. All right, that's enough theory. It makes way more sense when you see it in action. So let's run through a quick, practical example and see how these numbers actually come together. So let's meet the ABC partnership. We're going to figure out their provisional adjusted income for the year 2024. Step 1, nice and easy. We start with the net profit from their income statement. For ABC Partnership, that's 180,000 ringgit. That's our starting number. Next up, we look for those non-allowable expenses. First thing we see, they paid out 40,000 ringgit in salaries to the partners. Since the tax office sees this as profit distribution, we have to add it back to the total. Looking further, we see 10,000 ringgit in depreciation and another 5,000 in interest paid on the partner's capital. Both of these are non-allowable, so we add that whole 15,000 ringgit back into the pot. And now for the adjustment. Remember that depreciation we added back? Well, here's where we get to subtract its tax-deductible cousin, the capital allowance. For ABC Partnership, that's 8,000 ringgit. And there we have it. We started with our profit, added back the non-allowable stuff, and subtracted the capital allowance. The final provisional adjusted income for ABC Partnership is 227,000 ringgit. And that, my friends, is our total undivided cake. Okay, so we've got our PAI. That's the big number. But now what? How does this number actually turn into taxable income for the individual partners? This is where it all clicks into place. So watch this. We take our PAI of 227,000, and now we officially subtract the partners' salaries and the interest they were paid. What's left over is what we call the divisible income, and this is the money that gets split according to their profit-sharing deal. So going back to our cake analogy one last time, if the PAI was the whole cake, Then this divisible income of 182,000 ringgit. Well, that's what's left after you've already set aside the special slices for salaries and interest. This is the part that's truly up for grabs. So if partner A and partner B are in a 50-50 split, it's simple. They each get half of that divisible income. That's 91,000 ringgit each. That amount, plus whatever salary and interest they already received, is what they'll report as income on their personal tax returns. This table really sums it all up, doesn't it? It shows the two different worlds. At the partnership level, you're just trying to find the total profit, so payments to partners don't count as expenses. But then when you switch to the partner's point of view, those very same salaries and interest payments become their personal taxable income, along with their share of the profit. So to wrap this all up, what's the bottom line? First, PAI is the starting point for everything. Second, the partnership itself pays zero tax. Third, every partner is taxed as an individual on their share. The whole system is just there to make sure everyone's share of the profit is calculated fairly for tax. And that really just leaves one final question for you. Now that you've seen how provisional adjusted income works, maybe take a second to think about your own business. Are you guys handling your income this way? Getting this first step right is absolutely vital. Thanks so much for tuning in.